I feel like the cold opens are fun because I don't know. I just started listening to All In like a year or two ago, and they do cold opens, and I'm just like, we're gonna do cold opens here. So we're doing a cold open. How's it going, Steph? How you doing?
Hi, Matt. Doing great. How about you?
I'm doing awesome. I feel very excited to be back on the podcast grind. I didn't do much of it in 2024, but I'm doing 3 interviews this evening, which I am excited about because the last time I did 3 interviews was like 2020, so I'm like doing the crazy stuff again.
It's day one again. Yeah, it's great to be back. Thank you for having me.
Oh, 100%. I actually want to look back. I feel like were you within the first 100? Yeah, you were a 2020 interview right after COVID started. Interview. No,
Yeah.
hold on. You were where? OpenVC.
Well, that
When did
was a
I
long time
interview?
ago. That was years ago.
Yeah,
I
that was
was in,
2021.
yeah,
That was a long time ago.
I was in
What I
Portugal when we did our interview at the time,
where
and now I'm
so
in
you were
China. So
how did you? So you were in Portugal. Now you're in China. I feel like you've
yeah,
been in China for a little bit. I feel like we've chatted a few
right,
times over
right.
the last year. You've been in China.
Yeah, yeah.
When did you move from Portugal to China? And like really, like why did you make the move for people that are following
Yeah.
along?
So after I left the US, where I used to work, I spent 2 years traveling around Europe with my wife. We're lucky that, you know, our laptop is our office. So we got to live the digital nomad life for 2 years around Europe. That's when we spoke for the first time. I was in Portugal at that specific time. And when China reopened after COVID, we moved here because my wife is from here and she hadn't seen her family for 3 years because you know how it was during that time. And since we never really left, I guess we just like it here. So we keep traveling occasionally, but now China has become our headquarters for the past 2 years.
Do you feel like you get much exposure to like the tech or startup side of China? Like from what I hear, like I haven't seen it, but like China's just like killing it. Like they're just like everyone's learning STEM. There's so much going on. Like do you see much of that where you live, or is it hard unless like you're in those companies or in those like universities?
Yeah. So not where I live because most of the time I'm actually in the countryside, right? In a small town of 5 million people. So there's not much tech over there, although it's slowly coming. But yes, otherwise, just because of the nature of what I do, I get to interact with a bunch of founders and investors here. And I'm not deep in the Chinese tech space because to be deep, you would have to speak Chinese, which is not my case. And that's one of the first things you notice that in China, there are 2 tech scenes. There's the main one, which is the Chinese speaking, Mandarin speaking tech scene. And then there is a small subsegment that has usually mixed teams with one foreigner and one Chinese co-founder, and those guys speak English, and they are usually focused on e-commerce or cross-border fintech, remittance and this kind of stuff. So you have a small subcategory of startups that speak English, and there are a couple of accelerators for the cross-border projects, but the bulk of it, they speak Chinese. It's all in Chinese, and I hear I have second-hand information, but I'm not that connected in that one.
Yeah, that makes sense. Super interesting. As someone that's lived their whole life in Phoenix, Arizona, I've like always intrigued to just like know what else is out there. Obviously, I've traveled. Obviously, I've been to the Bay Area a trillion times and stuff. But like, I do have an urge to live somewhere else for like a year or two. But maybe that'll come after the kids are out of kids are in college or something. Because now I'm probably rooted here for 20 more years.
Yeah, well, we did exactly like you said. Like we don't have kids yet, and so that's why we traveled as much as we could. But maybe we don't travel so much in the future. We'll see.
Totally. So there might be a ton of people listening that didn't listen to the last episode, and for those curious that want to go back, that was episode 714, which was recorded in June 26, 2021. So for those that weren't listening to that, what are you doing? What is OpenVC? Just kind of share maybe what you do now, how you help founders, how you help investors, and we can dive into all the fun parts about that.
Yeah, so I co-founded OpenVC, an open platform that helps founders connect with investors And we're a software company. We're not a service company. So, we're not going to raise for you, but we're going to provide you with access, tools, and support to help you as a tech founders access investors, have all the tools put together to power your raise, and then avoid the big mistakes. And, that's the support part where founders need to know how to, valuation, pitch deck, and all that stuff. So these are really the three pillars of what we do. We launched was it 4 years ago now? It started as a side project that we launched on Product Hunt with Luca, my co-founder. And honestly, we had no plans. I just had this list of investors hanging in a Airtable, and I was like, how can we make this open and collaborative? And that's how it started. Put it on Product Hunt. It was a very bad product, objectively, but people love the concept. And we got a super strong start because of that. Because people just, look, guys, we love the mission. We love the idea of, having this community-driven investor list where anybody can contribute. And so for 2 years, we've built that as a side project while working on the side. And I think it was last year, 2 years ago now, that we went full-time. Yep, 2 years ago that we went full-time. And since then, it's been growing as a full-fledged platform for startup fundraising.
So a few things to dive into here. One, congrats on going full-time on it. I know it's not recent, but it's a very hard space to build in, but it's such a needed product. There's so many treacherous paths that founders can go down when they want to raise capital and start a company, and just knowing that you've been able to do it full time and sustain and grow is really important. I'm curious, how do you, when you serve founders, I feel like sometimes on Twitter, I do this too. There's some people need some tough love. They may come to you. They may say, hey, you can help me raise capital. Great. Here's $10 a month. Give me money or something, or connect me with investors. And it's obviously a much, much more nuanced process than that. And that because you're the founder, the co-founder of OpenVC. But oftentimes founders don't realize how nuanced this whole process is. Yeah. So how have you kind of, for lack of a better word, protected OpenVC? So when founders come, they know what they're getting, they know what they're not getting, and it's just kind of represented well to the thousands, tens of thousands, maybe hundreds of thousands of founders that are coming across it every year.
Yeah, that's an excellent question. And I mean, you're the first person to really ask me that question because you've been in the same space, so you know exactly.
Yes.
You know that this is the number one problem that people don't think about.
And for people, but before you answer, I'll give a little, for people that maybe are new to this podcast. I had a company called Seed Scout. I ran it for 4 years. Unfortunately, I shut it down last month. But Steph and I were in similar spaces, doing similar things, not the same thing, but working on solutions that serve the same market in different ways. And I made the decision to shut mine down last month for personal reasons and other reasons. But I've always been a fan of Steph and what he in OpenVC. Actually, that's why we had him on the podcast 3 or 4 years ago. So now I'm just all in on great. How can we get OpenVC out there more? Because Seed Scout's gone, so it's but I know OpenVC is a great option. So that's a little context for people that aren't aware of that. But yeah, feel free to go ahead and answer the question.
Yeah, and it's reciprocal. We've been following each other, and I really like what you've built with Seed Scouts. So. It is truly a big obstacle when you want to help founders raise funds because, just throwing a few things here. Number one, most founders are not fundable, and most founders should probably not raise funds. So, which means that your job, if you truly want to help them, is to probably reject 80% of your users or 80% of your potential clients. So that puts you in a very difficult position as an entrepreneur. And number two, there is the human aspect of it, a psychological aspect, is that some people don't want to hear that. Right? They think that for whatever reason they should raise, and if you tell them maybe you're not ready, maybe you should get more traction before whatever, they will hate you. And not only that, they will also accuse you of whatever, you're trying to steal my idea, or you're scamming me because you took my money, and I expected results. And these are honestly just people who are naive or immature, and it's a journey. And so that's a big picture for anybody new to that fundraising space. You're gonna have a lot of people who won't, and very, very few who will succeed, because truly the success rate is low for the whole industry. It's not specific to your product or my product or anybody. It's just what it is. Okay, and so you have to deal with that, because 99% of founders or first-time founders who've never raised, and they just don't understand the rules of the game. So how did we solve that? We've done two things. One, our core product is an online platform that connects founders and investors. And we put several systems in place to prevent the bad founders, and when I say bad, it's not a judgment, it's just founders that are not fundable yet, or who should not speak to that investor, to speak to them. So you're going to try to reach out to an investor. We review every submission manually, right? And we pass or fail it. When we decline it, we provide feedback. Okay, this is why we rejected your submission. This is what you should improve. And we refine that process over time so that people have actionable feedback. They don't feel too hurt. I mean, it still happens, but at this point, I don't care anymore. And then they can try again, right? When we reject, it's not a hard no. It's okay, this is the stuff you need to improve. And when they do and they try again, it's for their own sake, because honestly, we're not trying to be mean with people, but if the deck is just terrible, then it's not in your interest that we send it to the investor. And that way, what happens is we also protect investors, because investors learn that whatever they receive from OpenVC has been filtered, has been screened, and is reliable. And because of that, they pay attention to the deal flow we send them, and on average, we have 40% reply rate, 40, which is, really good for an automated, self-service platform. So that's the first thing we do.
It's incredible, because I feel like the cold email, the reply rate to just a standard cold email to someone without any help, like a platform or anything, is probably under 5%. Maybe it's under 2%. So for those listening, 40% is bonkers. So congrats to you on getting there.
Yeah. Thank you. It took time, right? I mean, every quarter I run the numbers and I see now we're at the point where we kind of plateau at 40%. And so we fight hard to get the extra 2-3% every quarter to get a little more. So that's number one, the screening. Number two, we automated as much stuff as we can to prevent founders from making mistakes. For example, for a long time, founders had to write their outreach email themselves. And a lot of them, they just make common beginner's mistake. They're going to write super long emails, talking nonsense. Again, just because they've never done that before. It's not something that you do in the normal life, right? So we automated a lot of things where, you have this AI now. AI has been great for us. AI can help you draft. We just ask you some key questions and we draft a good cold email for you that you can still edit before sending.
Love that.
And a lot of little things like that in the process where we, how can you say that in English? We prevent you from making mistakes unknowingly, right? As much as possible. So there is the screening, which is the bad side, and there is the productization of knowledge. So what a consultant could have done with you, helping you refine your outreach, the targeting, all that stuff, creating the shortlist. We've productized that, so it's done for you, kind of. That's number two. And then the last thing is just, we produced a lot of content, a lot of content about all the tutorials, how to build a pitch deck, how to value startup, how to do this, how to do that. And it's helpful. Originally, I did that because, people would message me like, hey, why did you reject my pitch deck? What should I do better? And I was tired of repeating the same advice, so I just put together a list. And then I realized that for a lot of founders, they will not raise, maybe now, but maybe they're raised in a year or 2 years. It's a journey for them. It's a learning journey. And so if I'm going to reject 90% of my users, I need to give them an alternative path. And that alternative path is going to be, okay, guys, maybe OpenVC is not going to help you raise, but it's going to help you learn. And so for you, there's going to be a masterclass, there's going to be workshops, there's going to be this and that, webinars, tutorials, playbooks. And so over time, we built this really large library of content, which is super detailed. It's all very actionable. It's not inspirational stuff. We're not going to tell you, stuff that makes you feel good. We're going to give you very, very operational, like step-by-step, 1.1, 1.1a of how you build your pitch deck or all those stuff. And that's also how we help people and we help ourselves. Because now we reject people, but we tell them, okay, this is what you're supposed to do. And then they read that, and then they get it. Okay, actually, I was super far from where I was supposed to be, and it makes sense. And then some of them learn and leave, and live and learn and improve, and others give up because they are not serious in the first place. And when they realize the amount of work, they just was, I wanted to play founders. Actually, it's not that easy, and I'm not gonna get money. Okay, I'm just gonna do something else with my life. So, and maybe they come back later. But I'm happy because now we don't say yes or no. We say A or B, right? Raise or learn, and it's a much better message for people.
That's incredible. Like, as you alluded to, and as I mentioned, like, I built in this space for a while, and it's like so hard to know what a founder needs, and more importantly, communicate that to them in a way that they like, they hear in a positive way. And I think just the reframing solely of like not a yes or no, but a or B tells you everything you need to know really about a founder. Because if A is funding, or not funding, but if A is access to the platform, then okay. If B is access to learning, if they're probably like a good founder, even if early, they will be super stoked, right, to learn through B. And if they're, not super stoked, then they just maybe throw a fit. It doesn't mean they're like a bad founder. Maybe they're a bad founder today. They're early today, but maybe they come back in a year or two a little more refined. I remember when I first started, like I was a freaking nutcase. Like I was like back in 2015, I was a horror. I was a nightmare as a founder. And you just learn and you get better over time.
Yeah. You are 100% right. And because this is everybody's journey. Like I've been there, and I know many founders who've been there. When we start in that space, we're full of shit, and we're full of ourselves. And then we meet other people who made it or who failed, and over time we learn. But it's a very slow process. It's a learning curve, and there's a difference between knowing something and understanding something. And when people tell you, like fundraising is hard. Yeah, you know it as an information, but you don't really get what it means, to raise, like where the bar is. You don't really get it until you've walked that path, and you understand it in your flesh, right? The challenges, the difficulties, and it makes you more humble. And that's why at the end of the day, when a founder gets angry, I don't really care anymore. Angry at me, I mean, because it means that they are just at the beginning of their journey, and they haven't learned humility yet, and they will, and I'm just in that part of their journey at the very beginning where they need to get a few doors in their faces, so they will learn. Okay, so this is actually they will calm down and they will grow up, but it's just a matter of, because someone who doesn't know how to handle rejection. It just means they're very mature, just means they have very little experience. And it's the first time or second time it happens to them. And so it's unpleasant for us on the receiving end, right, when we get angry emails. But it's also part of our role to, help people, climb that learning curve, right? That psychological, emotional learning curve as a founder.
I have a little bit like an inception question. So when you started OpenVC, like you didn't know what it would turn into. Like you said, you just had this list and you wanted to launch it and see what would happen. And you've since grown this thing to like something that's pretty special in my opinion. So if you were to look inward, when you launched OpenVC, how much, like, of everything you know now about this industry, take 100%, everything you know, how much did you know when you launched OpenVC versus how much have you learned through doing this work from since you launched OpenVC in the last 3-4 years? If I frame that question, correctly, because I have my own thought from Seed Scout. I'm curious to hear yours.
I think I had a lot of correct but very blurry intuitions. So I kind of knew that it would be hard to monetize. And that's why we did a lot of things the way we did them. That's why we kept it a side project for 2 years, because we knew this would be hell to monetize. That's why we didn't try to raise VC money, because we knew this is not a VC fundable case, right? And having this, and over time this was confirmed because just working on that space, something that is an intuition becomes a conviction. Is it how you say in English, conviction, or becomes a something that you're sure of, right? A certainty.
Conviction. Yep.
Intuition becomes okay. So that was right, but then some things were. Well, so here's the thing. I entered this with very few hard certainties. I was not like hardcore, like this is how things should be, and this is how I'm gonna build it. None of that. I was like, okay. I didn't even want to. I was like, I just closed my previous startup that had failed, and I had this investor list. Okay, how about I create a tool? I like creating for the community. How about create a tool for everyone to use? Let's see what happens, right? So no, it only became serious to us when we got the product of the day on Product Hunt. Like, okay, people really love it, and then product of the week, product of the month. Like, okay, then maybe we should spend time on this, but it was kind of pulled from our hands. We didn't go at it. And so I didn't have much certainties, but I did spend a fair amount of time in that space before. So I knew investors had too much deal flow already, and they don't really care, right? You're not going to sell them deal flow because they don't care. Even if you have the best deals in the world, they still don't care because it's going to take 10 years to prove that. And even then, half of them more than half would be dead, as investors by the time you're correct. And so, and the other half will be successful with their own deals. So your deals will have made no difference to them. Another intuition, just to give you an example. I believe that data doesn't really matter at very early stage. And I see a lot of projects try to gather a lot of data on early stage startups. Like creating very detailed startup profiles and stuff like that. But when you're like pre-revenue or even like up to seed, there's so little data that like this kind of stuff, data-driven VC makes sense at growth stage, but for very early, it's more relationship-driven, it's more psychology-driven, right? It's emotional. And so, you want to give them a few data points to get them excited and open the pitch deck. That's what we do, right? We tell them if the founder had an exit. We tell them if how fast the revenue is growing, but that's it. We don't go much further. And so these are things that that I had intuition for, and we watched the space, and we kind of feel we got confirmed in that direction. I could still be wrong, but I'm more confident about that than I was 3 years ago.
Totally. I think with Seed Scout, I went in thinking I knew enough about the industry to build a product to solve the problem, and 4 years later, I know less than I knew when I started. Obviously it's similar. I'm forgetting the name of the graph, but there's a graph where it's like, the slope of enlightenment graph, which essentially you think a ton about an industry in the beginning, and then because it's a slope, you're up, and then all of a sudden it gets popped here at the bottom, then you kind of level out over the next several years. And I think that I learned 95% about this industry after I started Seed Scout. And 5% was when my last company was backed by, I was backed by Jason Calacanis with my last company, and I went through an accelerator. And it's funny because in that moment, that's everything that I knew. And I thought, I'm like, oh my God, I was backed by Jason. I met Elizabeth Yin. I met whoever. Like, I know I can help founders. And it's just so funny because you need that mindset to like start a company, I think. Like, you need that mindset to like have the confidence to go out and like try to do something. But now, like 4 years later, I'm probably 10 times better suited to do that now than I was when I started. But that isn't it funny how kind of things play out, because I already kind of tried it. It's like it's kind of ironic. I don't know.
It is, but I think this is how it is. Very like there are two founders that you are in your life. The first founder is the arrogant, ignorant, overconfident one, right? That will crash, that will have a first failure or first battle scars, and 1% succeeds maybe, but that's fine. But then you live and learn, right? And when you start your next startup, because the beauty is that those skills are transferable. This knowledge and this learning curve is transferable. And whatever you do next, then now suddenly you're a repeat founder. And the connections that you've built, transferable. The knowledge you've acquired, transferable. The humility, transferable. The skills, transferable. And so if you had to build a new software product today, because it's not just the industry knowledge, if you had to build a new software product, you probably know a million things you would do different from before. Same with me. If I had to rebuild OpenVC today with everything I know, man, I would do it completely differently. I'm saying, like, there are a million things that I screwed up. Like, I could have saved myself probably 3 years, like out of 4. Everything I've done in 4, I could do in 1 if I had to, to repeat. It is what it is. And unfortunately, these are, you cannot just tell those things to people. Like, if I told myself if I could go back in the past, the problem is we don't listen. And we, even if we listen, we don't understand. Like, I have to make my own mistake. You have to make your own mistakes to learn. Otherwise, the experience process doesn't happen. You cannot just learn from books and podcasts. Although they are great, but it's not until you felt the pain, in your guts, and that's how you learn. I mean, that's what I believe.
Oh yeah, I mean, I agree. I agree big time, and it's like I do feel like when I started, I was more arrogant than I was. But I essentially have had 2 companies, but all kind of in the same era of like lack of capital and just running, like trying to like pay rent every month. So I kind of mentally consider it like, okay, from Publoft and Seed Scout was like early. That's my 20s era. Now I just turned 31, so it's like, what is my 30s era gonna look like in startups? And I'm kind of looking forward to it, because I think I left a lot of the baggage back in the 20s, and like you said, I kept a lot of the things that I've learned, to apply for the future. And any founder listening, if you failed in the past or you're failing now and you haven't shut it down yet, or you're succeeding and it may fail in the future, like Steph said, this is all transferable.
And I feel a lot of founders over-index for their current startups, but under-index for their whole lifelong entrepreneur career. I think more and more, because I've been in that space for now almost 10 years. And so I'm starting to see patterns, over time, because when I started, for example, I started almost 10 years ago at Microsoft. It was, let's say, Microsoft Accelerator. That's when I started. And some of the founders that I supported at the time, they're at seed stage. They just got their first exits in the past 2 years. I'm still in touch with them. And so I saw, and over 10 years now, I'm starting to see some patterns with a lot of people that I met. And I'm starting to understand after 10 years how things actually work. And so what I believed 10 years ago is that, you're young, you're energetic, you're intense, you want it hard, and you're going to work and it's going to happen. Actually, now I believe that, your first startup is probably not going to be a unicorn. You're going to do your best, you're going to try, but what's going to happen is if you really want it, you're going to stick to the founder life, even if you're not a founder the whole time, right? But you will start first company, fail or small success, whatever. Then maybe and then you're gonna have a second and or a third, and that one is much more likely to be a success. And if it's a success, much more likely to be a bigger success. I don't have data to back that. It's just what I've seen around me many times. So, like I said, people often founders, especially first-time founders, they over-index for the first startup, which is fine. I mean, you should have that fire in you. But just know, just like you said, don't worry, it's probably going to be the second or third one that's going to be the right one. And so you also have to learn how to protect yourself and not burn out and not become completely torn. I started the first startup before in deep tech, and it failed, and and it was painful, and I lost money, and but I'm back on the horse. So that's how it is.
What's that? From Clutch, was it Clutch Sports when Michael Jordan wrote his announcement, his press announcement when he came back, and his press announcement was 2 words. It's "I'm back," and then he came and won an NBA title. That's how it goes, right? That's how it goes.
That's how it goes.
Do you have? You've already shared so many what I call knowledge bombs on this interview. Lots of great things that founders can listen to and think about for themselves on their own founder journey. But is there anything that you would, if you could, like, I don't know, I could steal a question from, I'm forgetting who asked it, but like if there's any like thing you could share with every founder, if you had the power to say, hey, every first-time founder, you are now looking at these words in front of you, and you can't ignore them until you read them all and like read it twice, what would you share with all the first-time founders in the world if you had all their attention?
Okay. Something I've noticed is that a lot of people that successfully start VC-backed companies actually have already had a small success before. And for example, they're going to have, maybe they have bootstrapped a small business. They have 5K coming in every month from a small startup they had before. And so, or maybe they had a corporate career, invested in real estate. And so basically, they are in a position of comfort, in a position of strength. And that goes against that went against my own perception at the time that, you're going to be a little guy working from a garage, struggling to make ends meet. Actually, those guys are doing fairly well for themselves when they start a VC-backed company. And hindsight is 20/20, right? It's obvious that if you have had previous success, it means that you've built the skills, the network, and the cash position to do something more difficult and more risky. And so the conclusion from this is that smart founders build their own wealth first, and then they go VC-backed second, right? And people often think the other way. No, I need to raise VC money to be able to build my product, to be able to grow, to then become rich. And it might work for some people because they might have the track record that compensate for the initial success. But for most people, you need to show some past success to get VC money. And also because this past success will put you in a position of strength, whatever you want to do. So it's a subtle thing. I'm not sure it's very clear what I'm saying. But it's rare that your VC-backed startup will be your first success. And so once you really understand that, you think differently. You think, okay, how can I first bootstrap a business to 5K a month or 10K a month, right? That's what I need to do first. And then after that, I start thinking about raising VC money for that business or another business. But first I need a small success because doing that will give me the foundations for building a billion-dollar company. You don't go from the junior league to the Premier League, right? There are steps to the game, and that is something that took me a long time to understand.
Yeah, it's so true, and it's really not obvious, like you said in the beginning. But in hindsight, like I'm copying your words here, but hindsight's 20/20. Obviously, ones that are raising $4 million on a napkin are ones that already have found a lot of success. Not the ones that are just trying for the first time. Yeah. But we don't know that if you're just looking on Twitter out here in Phoenix or Atlanta or whatever, right, or China. Like you don't know that if you don't have the context.
Exactly. there was this blog post I wrote called "Venture Capital Isn't for the Poor." That worked really well. Obviously, the title helped. It's a bit
You know what
clickbaity.
you were doing there. Yep.
Yeah, of course, of course. But it was really cool because when I wrote that, I spoke with a lot of founders who came from very underprivileged background, right? People who are really poor, living on food stamps and stuff like that. And they all agreed. Like, these are founders who succeeded, right? Raise VC money and all that stuff. And they all told me, man, if you're poor, you have no business raising VC money. First, improve your own personal situation. Put you and your family in a safe spot. And then you can look at something, with high risk, high reward, like VC entrepreneurship. But before that, just get the basics in order. And sometimes we think, VCs are here to give us money because we don't have money, so we can build. No, they're not here for that. They're not here to compensate for, inequalities. They're not here to compensate for your lack of personal connections or your lack of personal funding. And if they say that, it's marketing. That's normal. They're doing what they're supposed to. They're supposed to say that because they want to, it's build their personal brand. But as a founder, you should be, aware of that and just read between the lines. Right? If they say want to be a first check in your company, they're not talking to you, unproven founder. They want to be the first check in the new company of Elon Musk, right? Or and this is the kind of stuff that, again, when it's your first time raising, you don't understand that. You have to go through a lot of pain to get the message.
You got to earn the insight. You don't just get it. You got to earn it through trying and succeeding, or more likely failing if it's your first time. But you got to get through it.
Yeah, absolutely.
Cool.
There's this stat, unicorn founders. 60% of unicorn founders are repeat founders, 60, and 42% of unicorn founders are had a previous exit at 10 million plus. So now imagine the population of people who had a 10 million plus exit, which is very small, right? And this small amount of people, 42% built a unicorn. 42% of the unicorn founders were from that small population, while the 58 other were from the rest of the population, general population. So that tells you the power of, repeating. No,
100%. I feel like I could talk to you about this for hours and hours. We've learned a lot. You've learned a ton. I've learned a ton. It's just like this industry there's levels to it. There's levels to the knowledge. But if someone's listening to this and they were like, wow, this guy, knows what he's talking about. I want to check out OpenVC. I want to know if I am going to learn or I'm going to, be able to get access to the platform or both. How can someone kind of start their journey with OpenVC? What's your website? How can someone kind of access what you got going on?
OpenVC.app. And as soon as you sign up, we will invite you to take what we call a fundability test. So you're going to answer 30 questions, take 6-7 minutes. Questions about your team, your traction, your round, all of that stuff. And we're going to tell you, okay, based on your answers, compared with the thousands of startups we have in our database, this is how you rank today, right now. Are you sexy for investors? And are you in the top 1%, top 10%, top 50%? And then these are the red flags. These are the reasons why you're not top 1% and what you can improve. Right. So that's the first thing that we do. And back to your initial question, how do we direct founders in the right direction? This test is a big part of it. And so just doing that, you get you get a lot of value. And this is free, by the way. A lot of what we do, that a lot of what we do is free for both sides. So you're going to take the fundability test. You're going to know, okay, I'm fundable. And then next steps, we're going to help you build your investor list, draft your cold email, build your pitch deck, all that stuff. All the tutorials right now are completely free and open. We have we have also a premium membership if people want some templates and some tools. But a lot of what we do is just community service, you could say. So that's for founders, and we also have some directories. We have one with pitch deck designers, one with which one is startup lawyers is coming live this week. MVP builders is coming as well. We have one for fundraising advisors. So we also have a directories of people who work in the space if you need some support. We basically built a lot of little tools. And thank you, no code, by the way. I've used a lot of no code tools for that to be able to ship fast. But I know that you're also a big fan of those tools. So.
Of course. A last question before we call it a day. You just said something that piqued my interest a little bit. What's your opinion on? What's your take on fundraising advisors? I guess I could qualify as one. I guess I don't know, but I feel like that industry is so. The quality varies so much in advisors. So just tell me, what's your take? Do you like it? Do you not like it? Yeah. What is there to know about fundraising advisors?
Okay. So we have to break it down into a couple of buckets. So first thing is that there's a cultural and geographical difference. In the US and a little bit in the UK, they are not very popular at early stage, right? US VCs don't like when a seed stage startup has fundraising advisor. That's just a cultural thing. In China, in the Middle East, it's a fairly normal thing, right? So there's cultural difference. So let's focus on the US because that's where the audience is. So in the US, I would say that you're gonna have two buckets. Let's say early stage and growth stage. So if your startup is like Series B, C, D, E, raising 10 million plus, it's fairly common to have some help with the raise, fundraising advisor, investment banker. These people will charge a fixed fee plus a success fee. And so they are expensive, but usually you're at a stage where you can afford it. And they are, on average, I'd say the quality is okay to good because they are incentivized on success fee, and to work at this level, at this later stage, you need to kind of have proven your worth, right? Because otherwise you're not going to close one deal, right? When it's our 50 million plus deals. And you're almost competing, with proper investment banks like the JP Morgan and all that stuff. So you have a little space, post 10 million and before 100 million, something like that. For independent indie fundraising advisors that still do a good job. Before that, here's what happens. From 0 to 10 million, it's probably not very profitable for a fundraising advisor to raise on success fees. Because if I'm going to help you start a raise and I'm going to spend time and activate my network and burn my reputation for you, I'm going to put the same effort for a $2 million raise or 20 million. I'd rather do the 20 million. I'll make 10 times more money with the exact same effort. Or even less effort, because at that point, your startup is more fundable. There are more data points. And so that's why a lot of founders say, hey, I want a fundraising advisor that works with me on success fee only, and I'm raising 500K. Well, that's never going to happen because it just, for a good one, doesn't make sense. And so you might still find some good people at early stage, but it's more common that they will work for a fixed fee. They say, look, it's a risk for me. You're very early. The success fee is meaningless because it's going to be too small anyway. And your probability of failure is going to be high, regardless of my work, right? It's going to be high because you're very early. So it's going to be fixed fee. And so it's not really, for me, it's not really fundraising advisory anymore. It's more consulting or coaching. You pay someone a fixed price for a consulting service. And they're going to help you, data room, pitch deck, investor list, outreach, just preparing with your pitch and understanding the rules of the game. I'm not against it. If you can afford it and you find someone good, by all means do. What I don't like is people who overpromise, underdeliver. I don't like people who prey upon naive, gullible, or just ignorant founders. So that I hate. But what I've learned is that there are many types of founders. You have people who have had a successful career, they have money, and they are perfectly fine spending 1K, 2K per month on a consultant or a coach. Good for them. And I've seen cases where it worked and they've received really good help, really good advice. Why not? But as you said, the problem is there are so many bad apples, that you're likely to get burned. Not even talking about scammers, not even talking about just people who don't know what they're doing. Because anybody can call themselves a fundraising advisor. Just like anybody can call themselves a founder, I guess. So it's a bad apples on both sides. And the last thing to consider, just because we're talking to US founders, there is something in the US called the SEC. And the SEC is the regulation authority for stock markets, and they also work in private equity. And so there are regulations in place. You cannot raise on success fee, or you cannot charge a success fee if you're not accredited or regulated or certified in the US, right? And so for that reason, a lot of people will want to help you, but maybe they don't have that certification. And that's why they'll charge a fixed fee. They'll say, okay, we charge $1,000 a month, because legally they're not allowed to charge a success fee. And you as a founder, you're also at a legal risk if you pay a success fee to someone who is not accredited. So, and this is for example, this doesn't exist in China. This doesn't exist in France. In France, anybody can charge a success fee. You're fine. In Switzerland, you're fine. This is really a common law thing. So, a common law country, Singapore, Australia, India, the UK, they have these kind of rules. So, and I think just with all those points I've covered, kind of the big picture on fundraising advisors. Again, there might be good ones at early stage. They're probably going to charge a fixed fee, and it's probably a tiny percentage of the whole population. So be extremely careful. Do your due diligence. Speak with their previous clients and ask about their portfolio, because you don't want to get scammed by one of those bad guys.
All right. That was extremely informative. Appreciate you sharing all of that. And we're going to end it there. If you want to check out OpenVC, it's openvc.app, right? Any other
Correct.
links you want to share? Are you pushing a YouTube, pushing a Twitter, or is it just your website?
Just go to OpenVC and we'll take good care of you. I'm on Twitter at Steph Nas. I'm on LinkedIn. Pretty easy to find, Stéphane Nasser. But yeah, all the path leads to OpenVC. So hope to see some founders there soon.
All right. If you're listening to this, check it out. And Steph, great to have you on for a part 2.
Thank you, man.